Can you hear me? Let's see. Can you hear me? Shit. It's frustrating. Getting a crazy echo. Can you hear me? Can you hear me now? How about now? Nothing? Shit. Can you hear me now? Nothing? Let's see here. Shit. Hello. Can you hear anything? Nothing? Let's see. Yeah, you do hear me? So you're okay, because right now your screen is blank. Oh, no. Now it's back. Okay. So you can hear me? Okay. No, I can hear you now. You can hang up the phone. All right, I'm going to go live in 1 second here. Hey, everyone. It's Noel Christopher with Renter's Warehouse. I'm doing another LinkedIn Live today and always dealing with minor technical difficulties. So I'm getting a little bit of an echo. So if you guys are hearing an echo on the live feed, please let me know and I'll see if I can try to rectify that. But today I have a great guest, and that is Rick Sharga. Rick Sharga, I've known for a long time. He's currently the company's with now. It's called CJ Patrick Consulting. And, I've known Rick since he was with auction.com, Carrington, and, we've kind of run in the same circles for a long time. So I'm going to bring Rick in right now, and he can give you his own description of who he is and what he does. All right, Rick, are you there?
I am here, Noel. Can you hear me?
I feel like I'm in the old school broadcasting. I'm like, are you there, Rick? Can you hear me?
Yeah, it's the old Verizon commercials over again. Yeah, and as I was saying to you while we were trying to get ready, the technology is always great when it works. So thanks for having me on today. It's great to be here. As you mentioned, I've recently embarked on a new phase of my running a small consulting practice called CJ Patrick Company, and generally what I'm doing these days is working with real estate, mortgage technology companies to help them with their business and marketing strategies. And so whether it's a company looking for a go-to-market strategy, a launch, a relaunch, looking to get funding, looking to create new lines of products, new brands. Those are the kind of things I'm getting involved in now, and it's kind of going back to my roots in a lot of ways. First half of my career was really doing marketing for a lot of different companies, a lot of technology companies in particular, before I ever got into the real estate and mortgage space. So it's kind of coming full circle in some ways.
So Rick, the way that I met you was
Running a small consulting practice called CJ Patrick Company.
Yeah, I'm sorry, my phone came on there. But the way I met you was, back when you were the auction.com days, and before that, when you were really growing in marketing, and the single family rental space was really going crazy. So tell me a little bit about that, and tell me kind of how you see this single family rental space, because that's what this is about. And then I'm going to, talk a little bit more about what you're doing, but.
Well, it's interesting because my entry into the real estate market was with a company called Realty Track, and I was there for the better part of a decade, and we published the largest database of foreclosure information in the country. And the bulk of our customers were investors, mostly individual investors, some institutional, and we knew some of them were buying and renting these properties, but we also had suspected at that point that a lot of them were in the buy and flip mode, because that was the cool thing to do in the market back in the day. When I got to Carrington, Carrington was actually an early participant in the single family rental institutionalization, if you will. And you know this as well as I do, but back in 2009, which is probably around the time when you and I first crossed paths, there were about 11 million single-family rental units across the country, and that number has grown to over 16 million today. So Carrington was working with one of the early institutional investors who was looking to buy these assets. We were all stunned by how rapidly the market kind of exploded back then, with the Blackstones of the world coming in and spending just ridiculous amounts of money in a hurry. And I've been involved, either tangentially or directly in the single family space ever since. Certainly at auction.com, where I spent 5 years, an awful lot of properties that we sold on the auction.com platform were properties that were sold to single family rental investors. And so it's been interesting to kind of have an opportunity to keep my finger on the pulse of that market over for the last decade.
Yeah, it's really been interesting, and I've been in it since the beginning as well, and really seeing it evolve. And I've been involved in that with what I'm doing with Renters Warehouse. It was investability, and before that, just a broker out there selling deals to funds. So the space has gotten really, really interesting. So how do you see the space evolving now? And I have some thoughts on this. I've seen a lot of new money coming into the space, a lot of new funds, a lot of efficiencies, a lot of disruption. You're able to now you've got funds buying in several markets. How do you see the future, and how do you see the housing market as a whole, and the talk of recession and things like that? Now, they talk about the inverted yield curve, and everyone's freaking out right now, but it's usually 22 months, if it does happen, a recession after this. And so when they talk about the stock market, by the time it gets to the recession, they've already priced in a recession way before. So just some interesting stuff there.
Yeah, everybody suddenly has become an expert on yield curve inversions. And that's welcome to the world of social media, right? The fact of the matter is, it's been a good predictor, but not an absolute predictor of recessions since people have been tracking it. And we're in a slightly different economic environment than what we've been in prior inversions. And even historically, you're looking at about a 60-40 split in terms of whether a recession follows or not. And your point's very valid. It doesn't follow the next Tuesday. It's usually a year and a half or more before the recession hits. I think there's been a fundamental shift in the single family rental market since the institutions got involved back in '09. It really is more of a business now. There's more scalability now. There's more professionalism now. There's more process involved. That's certainly something your current company's been involved with, both as a vendor and as somebody who's working with investors to provide those kind of services. But the fact of the matter is, even with the institutional money coming in, 90 to 95% of the inventory is still owned by small investors. It's still owned by people who own 10 or fewer of those properties. So while they may be managing those properties somewhat more professionally than maybe they used to 20 years ago, it still tends to be the purview of small to mid-sized investors. I haven't seen an enormous appetite from the big institutions to come in and buy like they did back at the beginning of this run. I've seen more of sort of typical institutional trades where they're selling off a certain amount of assets and replacing and replenishing with new assets. They view the market more as an asset class and as an investment opportunity in mass scale. But I think the day-to-day operators are the small to mid-sized people, and that includes some of the super regional players, the ones that will own a few hundred or a few thousand properties, and in some cases aspire to be the next innovation homes. But to me, it's a market that's not going anywhere anytime soon. We can talk about the housing market in general. I see household formation growing much more rapidly than construction in the new home market, and extensive research over the years has shown that people prefer to live indoors. So if you'd like to live indoors and they're not building any new homes for you to buy, you're going to be looking at rental opportunities, and even multifamily construction isn't keeping pace with household formation. So I tend to be very bullish on the category. I think there's a lot of opportunity, a lot of runway left in the single family space for investors.
Yeah, I agree. I think that, well, one note, and I can't really talk about it too much now, but there is going to be a couple of other big entrants into the space. I think when you see the ability to now source in multiple markets. For example, we have a acquisition platform can source in 40 markets. That makes it really interesting for these funds because you can sharpshoot, you can own properties in multiple markets, have the same operational efficiencies as you would if you were just concentrated in the top 13 or 15. And so, I see it evolving. And like you say, these regional or these mid-size investors, I just wrote an article in Forbes about this specifically, about not the mid-cap, but the mid-size investor who, like you say, they can be between, they could have 25 homes, they could have 2,000, and they can be regional or they could be national, and they're just that mid-size, and there's plenty of capital for them to execute those strategies. And so that's really exciting. And
the other thing, and I think you and I probably talked about this over the years too, is that particularly in volatile periods of time, U.S. real estate becomes a place where investors go to hedge. It's a flight to safety. We're not seeing as much international investment in U.S. properties right now primarily because the Chinese government has made it more difficult for high net worth individuals over there to get their money out to buy homes. But I really wouldn't be surprised as we see the stock market go up 500 points and down 800 points, with alarming frequency. If you saw some of the capital go into real estate, and one of the I wouldn't say easier in that it's not complex, but one of the easier places to park your investment dollars is in rental properties. You don't have to be quite as, it is stable, and it can be a longer term hold. Your acquisition costs if you're looking at cash flow returns. So I would not be at all surprised to see some institutional capital work its way back into the rental space.
Yeah, I agree 100%. I think that, I mean, real estate is so stable, and even with the ups and downs a little bit that we can have in a local market, it stays pretty stable over time. And I get this question from people all the time who are worried about
Noel, I lost your audio.
So basically I was saying, really, can you hear me now? Yeah. Real estate is so much more stable, or especially single family rentals. And so a lot of people ask me about their investment or the potential to invest right now. What's going to happen if a recession hits, and how is that going to affect the housing market? For one, there's a lack of supply in the housing market. So I've said this every single time I talk. It's more about lack of supply. There are affordability issues. There are funds I know now that have amassed a lot of capital to acquire and build and put out more of the workforce housing, not multifamily, but single family. And that's a niche in the single family rental space. There's a little bit more risk, but there's a huge amount of demand. So all that stuff is interesting to me, obviously.
So, one of the move by some of the builders to go into the build to rent category, I think speaks volumes. And I lost you again.
Okay. No, I said absolutely.
Okay. And I think that, the builders kind of keep their finger on the pulse of what's going on in these markets. Something people have to keep in mind about housing and recessionary periods is, if you go back historically, virtually every recession we've had, at the end of the recession, housing actually comes out with home price appreciation. Home prices actually wind up going up after the recession. The only exception to that, really in the last 50 years, is this last recession we went through. And that was because housing drove us into the recession. Housing and lending drove us into the recession. So there's an entire generation of home buyers whose history only goes back as far as maybe the boom and bust, and don't realize what it's been like in a normal cycle. And I think we have to remind them somewhat constantly that we go through recessions, we go through periods of growth. We're in the longest sustained economic recovery we've ever had. But it hasn't behaved like any other economic recovery we've ever had either. So, and housing still hasn't fully recovered from its perspective. We should be selling, just from a population, demographics, economic standpoint, we should be selling about 6 million existing homes a year. We should be selling about 750,000 new homes a year. We're going to come in way, way short of both of those numbers at the end of 2019.
So yeah, what do you think the new normal is, though? Because it's so hard to take what's been happening the last few years and then what happened the cycle before that on what the new normal is on renter population, or that, homeowner percentage. The fact is that there's a shortage of housing, and there's so many more housing starts. You have a lot of baby boomers who aren't moving out, or they're keeping their homes long term, and that fluctuates a lot. It depends on the market and the type of homes and how far out they were buying homes, because you see a lot of baby boomers who want to downsize, but they're not as much interest in the higher price for their homes from millennials. So anyways,
that's part of it. The millennials also are burdened with $1.5 trillion of student loan debt. That's making it harder for them to qualify for mortgages. It's making it harder to save money for down payments for mortgages. A lot of them came out of school at a time when the job market was awful, and so that kept them from getting that first real job when they came out of school, which has slowed everything down. So on average, it's taking them about 7 years longer to get into the housing market than prior generations. And I think that's been part of the issue. That said, they are coming in now. They're the biggest cohort buying homes. They're 2/3 of the market in terms of first home buyers. And there's so many millennials that as they come into market, it's going to put a great amount of demand into place.
Well, it's putting a lot of demand on rental housing as well. As all these millennial home buyers. Hey, I work from home and I have kids and dogs and all kinds of stuff. So
Mhm.
Like I say, it's a wild, wild west. But where there's millennials moving to buy, there's millennials moving to rent. I mean, that's
Yes.
just what it is. And there's baby boomers, and there's, I mean,
More of them are renting earlier, before they buy. So I do think they like the comforts of living in a home,
yeah,
even if they can't necessarily afford to buy one. The
of
other thing
course,
is, and anecdotally, although I don't know if the statistics have changed much in the last 18 months, but the last time I looked at it, the primary group of renters in single family homes was still Gen X. And
yep,
I don't know if that's changed much.
that
The
happened.
anecdote, we've seen millennials buying properties as investments before they buy properties to move into. So that's been interesting. But your point, the most important point I think we could probably leave people with today in terms of a whole millennial issue is household formation is finally starting to kick in. So millennials are moving out of your mom and dad's basement, and they're forming households, and that's going to do two things. One, mom and dad may now have a chance to sell the house that they couldn't sell before because Junior was living at home, and two, those millennials are going to be looking to live somewhere else. So household formation is going to go up far faster than home construction or even multifamily construction. So there are going to be ample opportunities for investors to provide housing of some sort for that cohort.
Do you think that investors are competing too much with first-time home buyers?
No, I don't. I think you probably have a little bit of that on a market-to-market
Of
basis,
course.
but nationally, I really don't think that's the case. The fact of the matter is that the builders aren't building first-time inventory, first-time buyer inventory, and
They
a
can't
lot of
afford to
you
in
can't
many
afford to.
cases.
If you're in California, according to Fannie Mae, it costs you $100,000 before you break ground. Really, really hard to build affordable housing if your table stakes are $100,000.
Yeah.
And the rest of the country, excuse me, averages 80,000. So it's not that much better everywhere else. So that's a problem. Labor prices are going up. The cost of capital for a lot of the builders is going up because of the amount of time involved. So we're not seeing that, and the people that are living in what would be move-up homes aren't moving up as quickly as prior generations did. So that inventory is staying off the market. So it's not like the investors are going and gobbling up all the first-time inventory. There's just not a lot of first-time inventory.
Yeah, that's very true, and I agree on all counts. So that's why, you know, any recession that's happening, there's still a need for housing, and
Mhm.
those household formations are happening. There could be some things that, you know, ebb and flow with that in housing. So tell me, I mean, you look at this and you look at the economy. You know, what are your thoughts where we are with the economy? Or is that something you feel like you can answer? Because I don't know if I can.
I don't know if anybody can. I think a lot of people give answers, but I wouldn't put a lot of money on the outcomes. We're due for a downturn. We're overdue for a downturn. This has been the longest recovery in recorded history in the United States. So we go through cycles. We're always going to go through periods of growth and periods of recession. Most of the economists I talk to feel that the most likely time for a recession is sometime in 2020. That would be a really unusual time for a recession because we almost never have a recession during an election year.
Correct.
For a presidential election cycle. So I think that's why you're seeing a lot of flailing going on in DC right now. People trying to figure out how to forestall the inevitable. The only thing that really, the only two things I see that could tip us into a recession pretty quickly would be the Fed overreacting and trying to slow things down, but they're not doing that now. They just reduced the Fed funds rate at their last meeting. That's
Right.
not what the Fed would do if it's trying to slow down the economy. The other thing could be these trade wars. We could have unintended and pretty significant consequences. If you look at the employment numbers, one of the things I've noticed over the last couple of reports is there's been some weakness in manufacturing, which had been a strength of the economy since the new administration took over. I think a lot of people tie that weakness in manufacturing to the trade wars. Because you have to remember we're manufacturing stuff that we export as well as stuff that we consume here. So I wouldn't be surprised to see a recession in 2020 or right after that. I don't think it'll be a major recession. And the thing that people looking for distressed property inventory need to keep in mind is that the lending standards have been so tight over the last decade, and the amount of equity that's been built up by homeowners over the last 10 years is now at a record level. We're not going to have the same kind of fallout for a recession as we had last time, when people were getting 120% loan to value loans, and they didn't have a job and didn't have any income, or were getting a mortgage anyway, and they were buying overpriced properties. The property values we're seeing today are driven up by supply and demand, and that's how economics is supposed to work. So I don't think you have a huge foreclosure risk when we have the next recession, unless it's much more severe than we're expecting.
I agree with you there. I'm curious what, there's a lot with the auto loan defaults going up, and just record amount of kind of subprime in the auto loan. I don't know how much that's going to affect the average consumer, because a lot of those people that are defaulting on the auto loans don't own a house as it is. So sometimes people try to correlate those things here. Student loans, I'm more concerned about what's that doing to future generations than I am in the housing market. I mean, it does affect affordability, but there's a lot of other things that affects affordability. Lack of saving for a down payment. But the income is there. So it'll be interesting. And that's why the rental market's going to stay strong. I don't think it's hurtful for the current, home ownership rate. I don't think it's at an unhealthily low number. I think it's at a pretty healthy number.
Historically, we've been around 64%. We spiked up to around 70% back right before the market crashed. It turns out 70% was too high a number. And that's when the government was determined that everybody should own a house. And that turned out to be a kind of bad idea.
Right.
And I think it's, one of the worst things you can do to somebody is put them in a house before they're ready financially, and then have to take it away. And that's really destroyed a lot of people's lives, at least from a financial perspective, since that happened. So right now we're bouncing around between 63.5 and 63.6% home ownership. What's interesting is that percent is holding even as household formation is increasing. And those are the things you want to watch, that the relationship between percentage of home ownership and the number of households being formed. And if all we do is maintain 63.5% as households, grow by 1 million a year, that says a lot of people are owning houses, and a lot more people are owning houses than owned the year before.
So, yeah, I agree with you. And so what do you think about the rise of these, tertiary markets, which are really not tertiary markets anymore? The Cincinnati's, Kansas City's, St. Louis, Indy, Columbus, Charlotte, Greenville, Columbus, South Carolina, Boise, Idaho, Colorado Springs. I mean, the list could go on. And I'm actually reading from a list that I just recently had a call with a pretty big fund of the markets they're going to be focusing on. And it's really interesting to see this. And I think it's a broader conversation about how there's a shift in our country, and a lot of shifts happen in economies after a big downturn. Certain cities and sub economies recover differently than others, and a lot of these smaller, what I've seen is gone from people moving to suburbs to moving to suburban towns and cities, and that there is a difference. There is, because they want that life experience.
Well, I think you said it right. Shift happens.
Yeah.
And I think we're seeing a couple shifts here. One is an investor strategy. If you're looking at buy and hold for rent, there's a price point you really can't go over. If you're looking to get cash on cash returns, if you're looking for cash flow returns. I think you have coastal California, you have the Northwest around Seattle, you have markets like Portland, you have even some markets like Austin that are frankly priced too high for most people to successfully be able to buy a property and then rent it out at a profit. There's a house on my street that's renting out for probably $100 a month more than I'm paying into my mortgage. Um, and it's a big family, and it's really probably the only kind of place that they could live. But that's a one-off.
Right.
I don't think you're going to have a huge demand for that. So we've seen the institutional guys for a number of years moving to the Midwest and Southeast, where you can buy a property for $85,000 and fix it up and rent it for $900 or $1,000 a month and make a nice return on your investment. So that's just economics. That's just dollars and cents. The other thing that's happening though, is you are seeing people move out of high cost, high tax states, cash in on the equity of the house they just sold, and have a much better lifestyle somewhere else. And your flight out of Chicago, where you would know that better than me.
Yeah.
Being
I was one of those people that flew out of Chicago.
But I mean, how many people do you hear now commuting to a job in Illinois from Milwaukee
or from Indiana?
Yeah, and so California, huge exodus of people leaving the state. You're seeing New Yorkers move to Florida in droves, and and even New Jersey. So I think you look at those states that again are high price, high tax states, and I think the last set of tax reforms may have been the straw that broke the camel's back for a lot of people who California. We kind of joke about paying a weather tax. But there's some point where that tax gets so high that you just say, it's not worth it. I'll put up with winter. And I do think we're seeing fundamentally a shift, and a shift from a lot of companies who are moving into more business friendly states from the states we were just talking about.
I'm going to pull up, if I can. I had a migration map here that I just want you to see, just so people who are watching or rewatch this. It's very interesting because let's see if I pull this in here, and California will be the prime.
Yep. Yeah, and it changed the housing dynamics. So as companies move, they take jobs. People, those employees need some of. In a lot of cases, they may rent before they buy if they're moving into a new state. I'm looking at your map, and the one thing that I'm curious about going forward is if we'll continue to see Washington being one of the states people move to, as opposed to where people move from. Because if you look at market dynamics, Seattle, the last 5 years probably, I believe has had the highest percentage increase in home prices of anywhere in the country. And part of that has been tech flight from the Silicon Bay area to Seattle. So it'd be interesting to see if that shifts. And then you have outliers. It'll be interesting to see what Amazon moving into Virginia is going to do to that area. And we know home prices are already escalating there. So it is interesting to see how this all plays out. And I do believe that some of this is due to tax laws, and what the final result of that has been on people's lifestyles and their financials. Yeah. And I do think people are more, at least this current generation of employees, probably a little more reluctant to enter into that long-term financial commitment than the parents might have been. When the move is buy a house as soon as you can so you can start accruing equity. Now you may have to move 4 states over because that's where your new job is. And what happens if you can't sell that house? And again, this is an age group that's grown up where probably everybody in it knew somebody who got foreclosed on and lost their house. So they're probably a little more conservative than prior generations were. Oh, look, and probably the thing I'm worst at, by the way, just so you know. Um, yeah, it's been a fascinating run over the last 17, 18 years in the space, working with companies like RealtyTrack, who when I joined them was a startup. I've gone through a couple different iterations of Carrington, and then with Auction.com getting a chance to rebrand the corporate entity as 10x and be part of a team that executed a sale liquidity event to a private equity firm. Um, so these days, what I'm really looking at is having the opportunity to work with companies in the real estate, mortgage, and technology spaces, and consult with them on what they need from a business and marketing strategy. Um, I spent the first half of my career really working with companies doing a lot of branding, a lot of marketing for big international companies like Fujitsu and Hitachi, big software companies like Sybase and JD Edwards, and then a bunch of startups, in addition to a little bit of more business to business marketing, consumer marketing. But for companies that are looking to enter a new market, companies that are looking to launch a new business, a new product, companies looking for go-to-market strategies, looking to find ways to accelerate their sales, or even just to effectively differentiate themselves against their competitors. Those are the kind of things I really like to work with to help figure out. And it's fascinating how often getting involved in those kind of marketing discussions changes the entire arc of what a company is going to do in the future. Um, Mark Twain said something once about how important having the right word was as opposed to almost the right word. And I remember there was a comment about lightning bolts and lightning bugs. And I know personally there's only one of those I'd like to catch in a jar. Um, and so one of the things I do really work with closely with companies is their messaging. What is their core value proposition? How do they express that to their audiences? And how they express that varies by audience to audience. You talk to investors differently than you talk to customers, differently than you talk to business partners. Um, and of course, my background, most people in the industry know me from a lot of the activities I've had with the media. So I bring that kind of expertise and experience along with me for companies that are looking to broaden their exposure in the media. So I'm working with a company launching in the commercial space right now, a transactional platform called By Proxy. I'm doing a little bit of work with a company who's trying to create an exchange platform for real estate and mortgage data, which is a nightmare if you've ever tried to license it. A company called Data MPX. These are both startups. And I have a few other companies I probably shouldn't mention because there's one in alternative financing that's helping consumers compete with iBuyers on a market by market basis. There's a company that works with attorney firms and helps them get business. And so I'm in discussions with a number of different companies. But again, for any company looking for a way to freshen their marketing, to change the way they approach their customers, their prospects, those are the kind of things I really enjoy getting involved in. Mhm. I think branding has become more complex and more multifaceted over the years, and I think social media has had a lot to do with that. I think a sort of lack of trust in traditional advertising by younger consumers has had something to do with that. So the brand has become more experiential. And I think you said something really important that I've noticed too is people don't realize, management typically doesn't realize the importance and the influence all of the employees of a company have on the brand experience that their customers and their partners have. So it has become more experiential. That said, there's still a need for basic branding functions like brand awareness and the image that the people have of the brand. I'm in discussions with one of the largest database providers in the real estate industry. And their issue is they're getting out marketed by all of their competitors to the point where the last two companies I've worked for didn't even know that this company was in the data licensing business, even though they've been in it for years and arguably have the best data set in the industry. It makes it really difficult for their salespeople if that company is not in the considerations that they want. So I think there's still a need for things fundamentally like brand awareness. Then the impression, the image your brand has, the reputation your brand has becomes really, really critical. Because now I know about you, but if I think you're bad, I'm not going to do business with you. And the brand promise has to be executed by all those employees, and every time the consumer has an experience with the brand. So there's an old line that I learned in college, which is the fastest way to kill a bad product is good advertising. And I think that's true today. If you pretend to be something you're not and the consumer figures that out, it's going to be really hard for you to get a second chance. So long-winded answer, but I think you're right, but I think it goes beyond just the experience part of it. And the other part of it is marketing as opposed to branding. You know, the KPIs are still really important for somebody who's trying to generate a high volume of online leads for, say, a mortgage business. People might like the brand, they might be aware of the brand, but they're clicking on an ad on Google for FHA loans in the Midwest. And you have to figure out how to get them from the top of that funnel all the way down through your funded loan. And so that becomes an aspect of marketing too. Mm-hmm. Yeah. Like everything else, you can blame that on the internet because most marketing uh, was weak in terms of your ability to granularly report everything, and then the internet came along, and now you can report on when somebody blinks online, and that blink, of course, has a huge implication on your ultimate sale, I guess. Um, and so people started kind of overreporting, to your point. So it's a balance, but I do think your consumer relationship at the end of the day is the most valuable thing you have. And that's really what the brand impression needs to be. They can check out cjpatrick.com. It's CJ Patrick Company, but it's cjpatrick.com. You can follow me on Twitter at Rick Sharga, or send me a note on LinkedIn. I'd be happy to connect with your listeners. But I really appreciate you having me on, Noel, and hope we can do it again sometime soon.